Hello everyone. So I hope I'm clearly audible and the screen is visible. So hello everyone and welcome to EduTap and the Finance 360-degree session. So in today's session, we are going to discuss the four very important articles from the April 2026 and from the May 2026. Okay. So these are the four articles that we are going to discuss. The first two articles and the fourth article, they are released by the Reserve Bank of India. These are the notifications of the Reserve Bank of India, and this is the press release of the Reserve Bank of India. And the third article, it is from the SEBI. SEBI has released a circular regarding the PaRRVA. So this is what we are going to discuss. So first of all, give me a thumbs up if I'm clearly audible and the screen is visible. Okay, so everything is fine, I hope. So we are going to discuss the Reserve Bank of India Undertaking of Financial Services Amendment Directions 2026. So these are the amendment directions for the different regulated entities. What is the amendment that has happened? What is the background? All of this we are going to discuss. Next is for the NBFC's branch authorization. This we will discuss. And then there is the SEBI operationalizes PaRRVA. What is PaRRVA? What are the guidelines for the PaRRVA, as well as who will be the PDC or who has become the PDC, who has been authorized. Since when this PaRRVA will start working. Next, we will discuss about this MOU. So let's get started without any delay. First, we are going to start with the first article, that is the Reserve Bank of India Undertaking of Financial Services Amendment Direction 2026. Okay. So the Reserve Bank of India Undertaking of Financial Services Directions, these have the provisions governing the investment in alternative investment funds. I hope you know about the alternative investment funds. These are the privately pooled funds. These are the privately pooled funds. And see, like the mutual fund, everyone can invest in the mutual fund, and you, me, we as the retail investors, small investors can also invest in the mutual fund, but it has certain restrictions that where it can do the investment. Okay. So basically, in the mutual fund, what happens that we can invest in the mutual funds. Retail investors, small investors can also invest in the mutual funds, and the mutual funds can invest the money in the different securities as per certain guidelines. In the case of alternative investment fund take the investment or pools the money from the sophisticated investors, that means from the high net worth individuals or the institutional investors and such. So the alternative investment funds, they only take the money from the sophisticated investors, or they can only pool in the money from the sophisticated investors, and that's why they can invest this money further in the different securities with different risk profiles, and they have lesser rules and regulations in regard to where they can invest. Okay, so this is the basic idea, that the mutual funds, they pool in the money from the investors of all kinds, and they invest this money in the securities, but there are certain restrictions on which securities they can invest, because they are also catering to the regular investors. While in the case of alternative investment funds, they only pool in the money from the sophisticated investors, and that's why they can invest the money in the securities that have higher risk profile also. Okay, so I hope first of all the alternative investment fund is clear. Now the regulated entities. Who are the regulated entities? The commercial banks, including the small finance bank, local area banks, regional rural banks, urban cooperative banks, state cooperative bank, central cooperative banks, all India financial institutions, non-banking financial companies, including housing finance companies. All of these are the regulated entities of the Reserve Bank of India. Okay. Now these regulated entities, they are also the investors, or they also invest their money in the alternative investment fund. Okay, so the regulated entities, they also invest the money in the alternative investment fund. That means regulated entities, they are providing the money, or they are investing their money in the alternative investment fund, which this alternative investment fund is investing in different securities to provide the returns to the investors. Now, there are certain provisions regarding how much the regulated entities can invest in a alternative investment fund scheme. So, a regulated entity, a single individual regulated entity, shall not individually contribute more than 10% of the corpus of the Category 1 or Category 2 alternative investment fund scheme. So, Category 1 alternative investment fund scheme, they invest in the startups like the venture capital funds, the angel funds, they come under the Category 1. Okay, Category 2, they are the alternative investment fund that invest in the private funds also, the private equity firms. Okay, so Category 2 AIF, they are investing in different kind of securities. They are also investing in private equity firms. So this is the idea that the regulated entity, it shall not individually contribute more than 10% of the corpus of the Category 1 or the Category 2 alternative investment fund scheme. The aggregate contribution by all regulated entities total contribution should not be more than 20%. So this is the idea that the Reserve Bank of India or undertaking of financial services directions have the provisions governing investment in alternative investment funds. That means how much regulated entities can invest in alternative investment fund scheme. So in one scheme, how much investment the regulated entities can do. So a regulated entity that is regulated by the Reserve Bank of India shall not individually contribute more than 10% of the whole corpus of the Category 1 or Category 2 alternative investment fund scheme. So if in the scheme there is 100 crores, a single regulated entity cannot invest more than 10 crores. Okay, so this is the basic idea. The aggregate contribution by all the regulated entities combined in an alternative investment fund scheme shall not be more than 20% of the corpus of that scheme. That means from the regulated entities combined, there should not be more than 20% that should go in a particular alternative investment fund scheme. Now, the regulated entities referred above are commercial banks, including small finance banks, local area banks, RRBs, urban cooperative banks, rural cooperative banks, or the state cooperative bank or the central cooperative bank, all India financial institution, non-banking financial company. So these are the regulated entities. Now, think about it that let's say if a regulated entity, that is a bank, commercial bank, small finance bank, or whichever bank it is lending to XYZ entity. It is lending to XYZ entity. Okay, it has provided the loan of 100 crores to XYZ entity. Now, the bank is investing in the alternative investment fund. And it has the corpus of 1000 crore. So the bank, it is investing, let's say up to 10% it is investing. So it is investing 100 crores. A single regulated entity cannot invest more than 10% now. So let's say this particular bank is investing 100 crores. Now this 100 crores is invested in this alternative investment fund. Now this alternative investment fund is investing in the debt instruments of the entity, of the borrowing entity. So bank directly lent the money to the borrowing entity, that is XYZ company, as well as bank through the alternative investment fund is also lending to the borrowing entity, because the alternative investment fund is using the funds of the bank to invest in the debt instrument of the borrowing entity. Is it correct? The exposure of the bank, is it not increasing too much to a single entity? Can we say that there is too much exposure that this bank is having to this borrower entity now? It lent 100 crores and now through the alternative investment fund also there is investment that is happening in the debt instrument of the borrowing entity. So here it has been clarified that if a regulated entity holds more than 5% in an alternative investment fund and the alternative investment fund subsequently invest in a company that is already a borrower of the same bank. So basically, if the bank is investing more than 5% in the alternative investment fund and that alternative investment fund is investing in the debt instrument of the borrower entity, if the alternative investment fund is subsequently investing in the borrower entity of the same bank or the same regulated entity, the bank is required to make 100% provisioning on such exposure that is happening indirectly, through the alternative investment fund. Any confusion here? Any confusion? So if a regulated entity is holding more than 5% of investment in an alternative investment fund, and this alternative investment fund is investing in the debt instrument or the hybrid instrument that also consists of the debt instrument. So if the alternative investment fund is investing in the borrower entity, then the regulated entity needs to maintain 100% of provisioning. Okay? So this is the idea. Any confusion, anyone? Chalo. Clear. Nice. Very good. So what we have learned till now, that a regulated entity can individually invest up to 10% only, not more than that. And in aggregate, the regulated entities can invest up to 20% only, not more than that. Okay. And in case the regulated entity is investing more than 5% in an alternative investment fund, and the alternative investment fund is investing in the debt instrument of the borrower entity, then the regulated entity or the bank basically here, whose borrowing entity it is, has to maintain 100% of provisions for the investment that is done indirectly. Okay. So this is the idea. Now, if a regulated entity invests in subordinated units of the alternative investment fund, so alternative investment fund has the superior units or has the normal units, we can say, and the subordinated units. So the regular units or the superior units, they basically like if you have bought these superior units, then you will get priority in getting the profits. And when the loss is being made by the alternative investment fund, you will have to face the losses at last. But if you are purchasing these superior units, basically you will be getting a lesser percentage of the profit, of the returns. So you have less returns, you have less risk, because you get priority in the profits and you face losses at the end. But if you have purchased the subordinated units, you will get the profits at the last and you will face the losses the first, but you will get very high returns, very high percentage of the profits. Okay, so subordinated units have higher returns, but they have higher risk also, because they will face the loss first or they will get the profits at last. So this is the idea, that subordinated units, the regulated entities, they can invest in the subordinated units of the alternative investment fund, but the subordinated units, they have higher risk with the higher returns. And that's why it has been said that if a regulated entity invests in the subordinated unit of the alternative investment fund, the entire investment amount that is invested in the subordinated units, that is invested in the high risk area, will not be counted as part of its capital. Accordingly, the investment that has happened in the subordinated units by the regulated entity has to be deducted. This whole investment has to be deducted from the regulated entity's capital base, from the tier 1 and tier 2 capital. So basically, if the regulated entities are investing, let's say a regulated entity, a bank is investing 100 crores in the subordinated unit of the alternative investment fund. So these subordinated units have higher risk, and this whole investment the bank will have to deduct from its capital. Okay, from the tier 1 capital, tier 2 capital. That means this investment cannot be included in the capital calculation. That is the basic idea. I hope this is also very much clear. So now what's new? This was the guidelines that were released previously. Now what is the new information that you have to remember? The RBI has now exempted AgriSure, that is Agri Fund for startups and rural enterprises, from the above norms governing investment in alternative investment funds. So now AgriSure Fund, registered as a category 2 alternative investment fund with SEBI. For this particular alternative investment fund, the above norms will not be followed. So what were the other above norms? What were the above norms? that a regulated entity individually cannot invest more than 10% of the corpus of an alternative investment fund scheme. Regulated entities in aggregate cannot invest more than 20% of an alternative investment fund scheme. If a regulated entity is investing 5%, more than 5% in an alternative investment fund, and this alternative investment fund is investing in the debt instruments of the borrower entity, then the regulated entity has to maintain 100% of provisions on the indirect investment that has happened. As well as regulated entity, if it is purchasing the subordinated units of the alternative investment fund, then this subordinated unit, whatever investment has happened in the subordinated unit, has to be deducted from the tier 1 and tier 2 capital proportionately. Okay? Now it is said that the agri-sure is the category 2 alternative investment fund. Agri-sure is the category 2 alternative investment fund. Now, if the regulated entities are investing in this agri-sure, then the norms are not applicable. Basically, that is the whole idea. So RBI has now exempted agri-sure from the above norms governing the investment in the alternative investment fund. Agri-sure fund is registered as the category 2 alternative investment fund with SEBI. Applicable to following entities: banks, commercial banks, urban cooperative banks, rural cooperative banks, that is the state and the central cooperative banks, small finance banks, regional rural banks, local area banks, non-banking financial companies, all India financial institutions. I hope this is very much clear. Coming to the next article, and see, the team has prepared this very beautiful infographic so that you can revise in a very fast manner. Individual investment limit is 10%, okay, up to 10%. Aggregate investment limit is 20%. The applicability you can see here, provision norm is 5% rule. That is, if the regulated entity holds more than 5%, then the provisions of 100% has to be maintained. If the alternative investment fund is investing in the borrower company through the debt instruments or hybrid instruments that consist of the debt instrument. Subordinated units, they are not eligible as capital and they have to be fully deducted from the capital base. Exemption granted to agri-sure and applicability. So the infographics, I hope you are able to see the infographics and you are able to see that how they have been prepared for your easy revision. Okay. Now, RBI issued the NBFC branch authorization directions 2025 to lay down the rules for opening branches. Now, the next direction is regarding the RBI non-banking financial companies branch authorization amendment directions 2026. So, RBI has issued these directions in 2025 to lay down the rules for opening branches by different categories of NBFCs. The RBI has now amended these directions to provide operational flexibility to NBFCs for branch expansion while ensuring necessary compliance. Okay, so there is operational flexibility that is provided through the amended directions. Now, the NBFC is generally permitted to open branches without having the need to obtain prior approval from the RBI unless otherwise specifically restricted. So basically, NBFC, they do not need the separate approval, the prior approval of the RBI to open the branches. Now, opening of branch abroad, as a general rule, NBFCs are not allowed to open branches outside India. So, what is the general rule? That the NBFCs, they cannot open branches outside India. Only those NBFCs, excluding core investment company and housing finance company, that already had foreign branches previously and had informed the RBI earlier, can continue them, but no new branches can be opened abroad. Okay, no new branches can be opened abroad by the NBFCs. Closure of branches. Now, next is, if the NBFCs, they want to close their branch or office, then the NBFCs must give at least 3 months of public notice before closing any branch or office. If a deposit taking NBFC, that is taking the deposit from the public, that is connected with the public in that manner, if it is closing its branch or office, then if a deposit taking NBFC publishes such notice of closure in newspapers, it must inform the RBI or the NHB within 7 days of publishing such a notice. So first of all, you have to publish, NBFCs must give a notice of 3 months before closing any of the branch or office. And if a deposit taking NBFC is publishing such a public notice, then it must inform the RBI or the NHB within 7 days. Now the applicability is on the deposit taking NBFCs and the deposit taking housing finance company. Now the housing finance company, they also are under the supervision of the National Housing Bank. That's why it is said that information has to be provided to the NHB also. So deposit taking NBFCs, they have to inform RBI, and the deposit taking housing finance company, they have to inform the NHB and RBI. So this is the idea that if the NBFC wants to close its branch, it is absolutely fine to close your branch, but you have to give the public notice of 3 months. And in case of deposit taking NBFC, they have to inform within 7 days of publishing such notice to the RBI or NHB. It should send a copy of the same notice to the regional office of the RBI. Opening of a representative office abroad. Any confusion till now? Anyone? Any confusion? No? Chalo. So opening of representative offices abroad. If an NBFC wants to open a representative office abroad, it must first take prior approval from the RBI. So you cannot open your branches abroad, but the NBFCs, they are allowed to open the representative office. A representative office of an NBFC abroad is permitted only for license activities. License activities means communication, coordination, cooperation, cooperative actions between different groups or different departments or organizations. So the representative office of an NBFC, it cannot lend, it cannot borrow, it cannot undertake any transactions. It can only engage in the communication, coordination between the different companies. It can only help in the cooperation between the different companies and such. So basically, if an NBFC wants to open the representative office abroad, it can do so, but it cannot undertake any activity involving the outflow or use of funds. So that's why the branches are not allowed, because branches means that the transactions will happen. But the representative office, it only means that the license activities will be undertaken, the communication, cooperation will be done, market studies, research will be done through this representative office without any activity involving the transaction. The parent NBFC must regularly get report on the activity of its foreign representative office, that it is only undertaking such kind of activities such as the license activities, market studies or research. It is not involving in the transactions. If the office is inactive or reports are not submitted on the timely basis to the NBFC's parent, then the RBI can review or even cancel the approval. And if the NBFC wants to open the representative office abroad, it has to send the application to the Reserve Bank of India through PaRRVA portal. That is the platform for regulatory application, validation and authorization. Okay, so if the NBFC that wants to open the representative office abroad, then it has to send the application to the RBI through the PaRRVA portal. Okay, so I hope you understand the difference between the representative office and branch. Representative office can do the market studies, it can do the research, it can undertake the license activities, but it cannot do the transactions like the lending or taking the deposits and such. Applicability of these provisions apart from the NBFCs listed below. These provisions relating to opening of offices abroad also apply to core investment companies. So applicability of the above provisions is on the NBFC deposit taking, NBFC investment and credit company, NBFC factor, NBFC microfinance institution, NBFC infrastructure finance company, infrastructure debt fund, housing finance company registered with RBI. Okay. Now, branch expansion norms for deposit taking NBFCs. So, condition of deposit taking NBFCs. So, net owned fund up to 50 crore. See, condition of deposit taking NBFC, where can it open the branches or appoint the agents? So, this is important that we have to discuss. Okay. Till now, I hope there is no confusion. So branch expansion norms for the deposit taking NBFCs. There are certain norms for the branch expansion. So condition of deposit taking NBFC where it can open the branches or appoint the agents. So if the net owned fund is up to 50 crore or the credit rating is below the A level, only the branches can be opened or the agents can be appointed only within the state where its registered office is located. Okay, so remember this, that the condition of deposit taking NBFC is that if they have the net owned fund of up to 50 crore or their credit rating is below AA, they can open the branches only within the state where they are registered, okay? Where its registered office is located. Net owned fund more than 50 crore plus the credit rating is AA or above, they can open their branches anywhere in India. So here through this infographic you can see that what points you have to remember and the summary you can see. So general rule is that NBFCs can open branches without the prior approval of RBI within the country. Okay. NBFCs are not allowed to open branches outside India. Existing foreign branches, they are allowed only if such NBFC had taken the permission earlier and they had the branches earlier. Okay, no new foreign branches can be allowed. Closure of branches, so if the branches have to be closed, public notice is required for a minimum 3 months and within 7 days. If the deposit taking entities, they are closing their branches, they need to inform the RBI or the National Housing Bank within 7 days of doing the public notice. Opening of representative office abroad, this is allowed with the permission of RBI, but there are only limited activities that the representative office can do. And next is that applicability of the above provisions are on these entities. Okay. The box also you have to remember that the branch expansion, for the branch expansion, the deposit taking NBFCs, if they have the net owned fund, if they have their own net owned fund up to 50 crore only, or their credit rating is below AA, their credit rating is below AA, in this case they can open their branches only within the state where their registered office is present. Okay, if the net owned fund is more than 50 crore, if the net owned fund is more than 50 crore and the credit rating is equal to or above A, in this case the branches can be opened anywhere in the country. Now coming to the third article, that is the first article for your SEBI. So SEBI operationalizes PaRRVA to enhance transparency and investor protection. I will also show you the net owned fund requirement for the different NBFCs because that is something you have to remember from the examination point of view, okay? But that I will show at the end of the session. So first let's focus here. So SEBI operationalizes PaRRVA to enhance transparency and investor protection. So SEBI has operationalized the PaRRVA. PaRRVA is the past risk and return verification agency. Think about it. Let's say that there are the high net worth individuals, the big institutional investors or the non-institutional investors that invest regularly in the financial market in the different securities, and they are investing in huge amounts. Now how they will know that which company is good, which small and medium enterprise is good, where they should invest, which IPOs they should invest, which instruments they should invest? So they take the help of the investment advisors, they take the help of the investment advisors or the research analyst, or there can be algo trading that can be happening. Now which investment advisors can they appoint, or which investment advisors can they take help from? They can take investment advice from. Now there are some investment advisors that they are saying that their investment strategies have borne the return of 40% in the past 5 years. Or some research analysts are saying that their analysis have brought profits or returns of 30%, 30 to 40%, 30 to 50% in past 3 years. Now the high net worth individuals are seeing so many of the different investment advisors and the research analysts claiming different numbers regarding the returns that the investment advisors and the research analysts have brought for their investors. Now who to trust? Are they really investment advisors, research analysts, are they really telling the correct numbers? So for that the PaRRVA was launched. Okay, so basically the PaRRVA, it is the entity or it is the agency that is the past risk and return verification agency that verifies the data provided by the investment advisors or research analysts in regards to their claims regarding the returns. Okay, so I hope this is clear that the PaRRVA verifies the performance. So PaRRVA verifies the performance of the investment advisors and the research analyst. The PaRRVA sees or verifies the accuracy of the claims that is made by the investment advisor or research analyst, so that you can see that, okay, actually they are telling the truth or not. So basically for the customers, the good point will be, or for the investors, the good point will be that the PaRRVA will be verifying the performance claims of the investment advisors and research analysts. So if the investment advisors are saying that their returns that they are claiming are PaRRVA verified, that means the PaRRVA has verified the performance claims and they are true. They are true. So this is the idea. Okay. So SEBI operationalize the past risk and return verification agency that will verify the performance claims made by the investment advisors or the research analyst. The primary aim of PaRRVA is to bring credibility and transparency to the performance claims made by the financial intermediaries, that are the investment advisors, the research analyst. SEBI has established the PaRRVA as the performance validation agency. So remember, PA, that is past return risk and return verification agency. Okay. So this agency will offer validation services for research analysts, investment advisors, and algorithm providers seeking verification, that wants to seek the verification so that they can show to their investors or potential clients that their performance is validated by PaRRVA. If their performance is validated by PaRRVA, that means actually they have performed well, actually they have borne results for their investors. So this is the basic idea, that basically if the investment advisors, let's say they are claiming that in the past 5 years, their investment strategies for the different investors have borne 40% of the returns in the past 5 years. Now, many of the high net worth individuals and the institutional investors, they will be happy that, okay, 40% of the returns in last 5 years, that is really good. So they want to also hire this investment advisor for the investment advice. But what if the claims are wrong? What if the claims are not true? So in this case, investment advisor, let's say the high net worth individuals, they are afraid that what if the claims are not true? What if the claims are fake? So investment advisor, it can go to PaRRVA, and PaRRVA will verify the performance claims. PaRRVA will verify the performance claims, and the investment advisor will be able to show that their performance claims are PaRRVA verified. That means they are verified by the external entity. So now the high net worth individuals and the investment advisors and the institutional investors and such, they will be able to trust this investment advisor. They will become the client of this investment advisor. So this is the idea, that the performance claims are being verified by the PaRRVA. And this is also good for the investment advisors and the research analysts that are making true claims, because now their claims will be trusted by the investors, by the potential clients, because that will be PaRRVA verified. Okay, so this is the basic idea. So the investment advisors, research analysts, algorithm providers, that our algorithm, our algo is best in the market because we are providing the high returns and such. So these kind of claims can be verified. By acting as a specialized independent body under the SEBI's framework, PaRRVA verifies the risk and return metrics of the investment advisors, how much returns they are able to bring, how much risk is there and such. Research analyst and algo providers. The framework for PaRRVA was issued in April 2025, that is last year, and after a successful pilot phase that initiated from December 2025, the system has become fully operational from May 4, 2026. Now the eligibility criteria for PaRRVA. Who can become PaRRVA? Who can become the independent body to do the past risk and return verification? Who can become this agency? Who can become the agency? So first of all, the credit rating agencies, they can become the PaRRVA. They can become the PaRRVA. Okay. Now, what is the eligibility criteria for a credit rating agency for recognition as PaRRVA? So basically, the number of years of existence of the credit rating agency should be minimum 15 years. Minimum net worth of the credit rating agency should be 100 crores. Number of issuers which have obtained ratings from this credit rating agency, obtained ratings of listed or proposed to be listed debt securities from the CRA should be 250 or more. That means the number of issuers which have obtained the ratings of the debt securities from the credit rating agency should be 250. 250 issuers should have taken the rating or more than that for their debt securities. CRA should have investor grievance redressal mechanism to address the grievances of the investors, including online dispute resolution mechanism. So these, if a credit rating agency fulfills these eligibility criteria, it can become the PaRRVA to verify the claims of the investment advisors research analyst. Now the PaRRVA, there is also the PDC, that is the PaRRVA Data Center. PaRRVA Data Center, that is basically the agent under the PaRRVA. So the eligibility criteria for a stock exchange, see the stock exchange, it can become the PaRRVA Data Center. So so for the stock exchange also there are certain eligibility criteria. If they fulfill this, they can become the PaRRVA Data Center. Number of years of existence of the stock exchange should be minimum 15 years. Minimum net worth of the stock exchange should be INR 200 crores. 200 crores. The stock exchange should have a nationwide terminals, and it should also have investor grievance redressal mechanism and the including the online dispute resolution mechanism. So basically the credit rating agency, it can become the PaRRVA, and the stock exchange, it can become the PaRRVA Data Center if they fulfill certain norms. Okay, so for the credit rating agency eligibility criteria, they should be working for minimum 15 years, they should be in existence for minimum 15 years, minimum net worth of 100 crores, and they need to have provided the ratings for the debt securities to the 250 or more issuers. Okay, they need to have the investor grievance redressal mechanism. The eligibility criteria of the stock exchange to become the PaRRVA Data Center, their number of years of existence minimum 15 years, same, net worth higher 200 crores, nationwide terminals, and they should also have the grievance redressal mechanism for the investors. Now what is the key highlight, what has been the update, because these were the basic the guidelines that were released. So update is that the SEBI has recognized Care Ratings Limited as PaRRVA. So this is the credit rating agency that has been recognized as PaRRVA entity, while the National Stock Exchange has been recognized as the PaRRVA Data Center. Okay. Now the investment advisors and the research analysts who wish to communicate, see, so the investment advisors and the research analysts who wish to communicate certified past performance data to clients must enroll with PaRRVA by August 3, 2026. So basically, the PaRRVA has started functioning properly in full phase from May 4, 2026. Before that, whatever is the historical performance data of the investment advisors or the research analyst, so the investment advisors, research analyst can use their historical performance data if they join PaRRVA within 3 months. If they join PaRRVA within 3 months. Okay. So this is the idea that investment advisors, research analysts who wish to communicate their certified past performance data to clients, they must enroll with PaRRVA by August 3, 2026. Okay. Investment advisors, research analysts, they may communicate certified past performance data, that is historical past performance data, to clients, including prospective clients, only up to May 3, 2028. So whatever is the historical data that the investment advisors, research analysts have, they can show it to the clients only up to May 3, 2028. After May 3, 2028, only PaRRVA verified risk and return metrics can be communicated. So this is the basic idea, that basically if you want to show your historical performance data, you can show it to your clients or the potential clients if you join PaRRVA by August 3, 2026. And you can show this historical performance data till May 3, 2028. But after that, you will not be able to show this historical performance data. You will only be able to show the PaRRVA verified performance data. Okay? So this is the idea. Any confusion? So this is the idea, that there is the transition timeline that has been provided. So this is the transition timeline. This is the transition timeline that has been provided, that if you want to show your historical past performance data, that is certified or that is self-claimed. Okay, that is self-claimed. If you want to show your self-claim historical performance data, so you can show it if you enroll with PaRRVA by August 3, 2026. Investment advisors, research analysts, they may communicate certified past performance data that is self-claimed to clients only up to May 3, 2028. After that, only PaRRVA verified risk and return metrics can be communicated. That means after that, the performance claims or the performance data that is shown, that must be PaRRVA verified. Okay? Historical performance data from the pre-PaRRVA period will no longer be allowed in client communication. This is the idea. So the PaRRVA concept and functioning. PaRRVA is designed as a centralized verification mechanism to validate the past risk and return claims of the market intermediaries, investment advisors, research analysts and such. That whatever they are claiming, is it true or not? Whatever returns they are claiming, is it true or not? That the investment strategies have borne the result or have borne the returns of 40%, 50%, whatever claims they are making, is it correct? Or they are saying that their investment strategies are less risky, is it correct or not? So whatever claim the market intermediaries are making, that will be verified by the PaRRVA. It ensures that any performance data shared with investors, with the clients, is authenticated, standardized and comparable, thereby reducing the risk of misleading or exaggerated claims. So the investment advisors, research analysts will not be able to make the exaggerated claims, and any performance data that they are sharing with their investors will be verified by the PaRRVA. Investors will gain access to reliable and verified performance records, enabling more informed investment decisions, that which investment advisors they should connect with, which research analyst is good, which have better performance as per PaRRVA verified claims. Okay. Use in advertisements. SEBI has permitted regulated entities, that is the research analyst, investment advisors, to use PaRRVA verified performance data in advertisements, that yes, our performance data is verified by PaRRVA. So you can understand that this, let's say they are claiming 40% of returns in the past 3 years. So if it is PaRRVA verified, they can show it in their advertisements also, that okay, our claims is PaRRVA verified, so you can trust us. There will be more trust of the investors on these particular investment advisors and research analysts. This ensures that promotional claims are backed by credible, independently verified data. Okay. So this is the idea. Like, think about it, that the financial statements are released by the company. So this is as per the internal calculations, that the financial statement is released by the company, that we have made the profit of let's say 100 crores, and the profit has increased by 15% from the past year. The financial statements is also showing that there is good percentage of debt to equity ratio, that the debt to equity ratio is less, there is less debt that is taken, and so you are trusting this financial statement of this company. But here the auditors, they also audit the financial statement, so that whatever is written in the financial statement is true. Okay, it is true. So basically, when the financial statement is released by a company, when a financial statement is released by a company, you trust this financial statement when a auditor, a statutory auditor, independent auditor, the legal auditor has audited the financial statement of the company. Then now we can trust the profit claims of the company. Now we can trust the other financial data of the company, because it has been audited by the auditor. Similarly, if the investment advisors, if the research analysts, they are claiming certain performance metrics, they are claiming that their returns have been higher, their risk has been lower, whatever investment strategies they have been informing has been good. So you can trust the performance claims if they are backed by PaRRVA, if they are verified by PaRRVA. Similarly, so like the auditor is auditing the financial statements, and you can trust this financial statement now because it has been completely audited. Similarly, the performance claims made by the regulated intermediaries can be trusted if they are verified by PaRRVA, and the investors can trust it more. Okay? So this is the idea. Now coming to the last part, that is the last article, the fourth article that we had to do. Reserve Bank of India and European Central Bank has signed the Memorandum of Understanding on Mutual Cooperation. So basically, Sri Sanjay Manotra, Governor of the Reserve Bank of India, and Ms. Christine Lagarde, President of the European Central Bank, today signed a Memorandum of Understanding on cooperation in the field of central banking. The signing took place alongside the Bank for International Settlements meeting in Basel. So there were the Bank for International Settlements meetings that were going on, and alongside that there was the MOU that was signed between ECB and RBI. The MOU, which updates the previous MOU of 2015, provides a framework for a regular exchange of information between the Reserve Bank of India and European Central Bank, policy dialogue, and technical cooperation between the two institutions in areas of mutual interest in the field of central banking. So basically, the MOU has been signed in the field of central banking so that they can cooperate in a better manner with each other. And the signing of the MOU took place alongside the Bank for International Settlement meetings. Bank for International Settlements, it provide a platform for the different central banks to come together. Okay? So this is the idea. Any confusion? Now, as I told you that I will show you the owned fund data also. So just give me 1 minute. Let me open another file. So I will show you the data for the owned fund of the NBFCs. That is very important. Okay? Just 1 minute. Till then, if there is any confusion anyone has, kindly ask me. Any confusion anyone? Okay. So here you can see the data, owned fund data. So a company desirous of commencing the business of non-banking financial institution, it should be a company incorporated under Section 3 of Companies Act 1956. So in case of NBFCs, there is a lot of discussion that has happened on the net owned fund. There are different directions that the RBI has released. So that's why the net owned fund is important. So the NBFCs, they should have a minimum net owned fund of 10 crore. The minimum net owned fund requirements for specialized NBFCs. So there are certain specialized NBFCs like the Infrastructure Finance Company. So for that, the net owned fund should be 300 crore. Net owned fund is basically the owned fund of the NBFC, that is its owned fund. Its own fund that consists of the shareholders' capital, how much shareholder is invested in the NBFC. The owned fund also includes the part of the profit that is kept with the NBFC, that is the retained earnings of the NBFC. So owned fund is the actual owned money of the NBFC that is owned by the NBFC. It is the shareholders capital or the paid up share capital that is invested in the NBFC. It is also including the retained earnings with the NBFC from the profit. Okay? So the net owned fund of the Infrastructure Finance Company should be 300 crores. Infrastructure Debt Fund, for that also 300 crores because they are dealing with infrastructure. Mortgage Guarantee Company, for that the net owned fund should be 100 crore. Housing Finance Company should have the net owned fund of 20 crore. Standalone Primary Dealers should have the net owned fund of 150 crores. And standalone primary dealers which are doing the non-core activities, they should have the net owned fund of 250 crore. NBFCs for account aggregator and peer-to-peer, they can have the net owned fund of 2 crores. This is the idea. Now all NBFCs, they are not entitled to accept the deposits. Only those NBFCs that hold a deposit accepting certificate of registration from the RBI, that means they have been allowed to accept the deposit. They can accept the deposit, and if they have the minimum investment grade credit rating of BBB minus from any SEBI registered credit rating agency. So basically, NBFC can take the deposit if it has the certificate of registration from the Reserve Bank of India, which allows the NBFC to take the deposit, as well as if this NBFC is having the credit rating of BBB minus and above. Then the NBFC can take the deposits from the public. And deposits from the public are allowed up to a limit of 1.5 times of their net owned fund. So the NBFC can take the deposits up to 1.5 times of their net owned fund. So if the net owned fund is 100 crores, the NBFCs can take the deposit of 150 crores. ठीक है? So presently the remember that the NBFCs, they cannot take the demand deposits that can be withdrawn on demand. The NBFCs can only take the time deposits that are deposited with the NBFC for a minimum period of 12 months and maximum period of 60 months. They cannot accept the deposits that is repayable on demand. They can accept the deposit for a period minimum 12 months, maximum 60 months. So these are some of the important points that you had to remember. These are the static points, but from the static GA also, from the static finance also, the questions are coming if they are linked with the current affairs. And as the net owned fund was discussed here, that on the basis of the net owned fund, the branches can be opened. So if the net owned fund is up to 50 crore or credit rating is below AA, only within the state the branches can be opened where its registered office is located for the NBFC. If the net owned fund is more than 50 crore plus the credit rating is AA or above, then the branches can be opened anywhere in India. Okay, so this is the idea. Now let's go to the questions. So these are the questions that you have to answer in the comment section below. So first of all, consider the following statements regarding RBI directions on investment in alternative investment funds. Aggregate contribution by all regulated entities in any AIF scheme shall not exceed 20% of the corpus of that scheme. Investment in subordinated units of an AIF is fully deducted from the regulated entity's capital base. AgriSure is registered as a category 1 AIF with SEBI. So try to see that which of the above statement is or are correct. Okay. Next, consider the following statements regarding RBI NBFC branch authorization amendment directions. NBFCs are generally permitted to open branches without prior approval of RBI unless specifically restricted. New foreign branches can be opened by all housing finance companies with prior approval of RBI. Representative offices abroad are permitted only for license activities, market studies and research. So which of the above statements is or are correct? Okay. Now consider the following statements regarding PaRRVA. PaRRVA is designed as a centralized verification mechanism for validating past risk and return claims made by market intermediaries. Care Ratings Limited has been recognized as the PaRRVA entity. Bombay Stock Exchange of India will act as the PaRRVA data center. So which of the above statements is or are correct? So this is it for today. I hope you enjoyed the session. If there is any confusion, you can ask in the comment section below. Okay, so we have covered the 4 articles in today's session. So this is it. Thank you everyone. Thank you for joining. And if there is any confusion, you can share your confusion in the comment section